Hello fellow traders, Marv Eisen here from Timeless Dollar Trading Academy, and I want to answer a question, a very good question, that was put to me by one of my viewers this week. And the question was, Marv, how do you know that the Taylor calculated numbers are accurate? And the quick answer to that, the very simple answer to that is the numbers are products of a formula of calculations. And in the question of the Taylor numbers, the Taylor calculations are based on 12 calculations that are averages of averages, and they boil down to two numbers, a support number and a resistance number. So how do we know that the Taylor numbers are going to give us good guidance and help us trade more profitably? And so I'm going to use a 1-week example from Monday, March 18th to Friday, March 22nd. And you see the 5 trading days here. And I'm going to take you through each of these 5 days and show you what I'm talking about in terms of the Taylor numbers being accurate in terms of the calculations, but how do you use them to trade more profitably? So let me drill down to the actual days. So starting with Monday, March 18th. On Monday, March 18th, the Taylor resistance number was 51.97, support was 51.62. And the market started up way up above the Taylor resistance number and traded well above the Taylor resistance number all day. The Taylor calculated trading zone was well below. So if you're going to use the Taylor numbers to help you trade and the market doesn't trade within the Taylor numbers, then don't trade the Taylor numbers, okay? But the Taylor numbers are going to give you a range for the day. And if the price is not going to trade within the range and you want to use the Taylor numbers to help you trade more accurately, then don't use the Taylor numbers that day. Let me go over to Tuesday, March 19th. So here's Tuesday, March 19th. Taylor started up right at the predicted support number, traded down below that for a while, and then traded way up through the Taylor calculated range for the day. And a smart trader who wanted to use Taylor would get on at the support number at 52.05, give it a little wiggle room, get on at 52.10 thereabouts, and get off at 52.37. So a 27-point trading day, not too bad in anyone's book, okay? Now let's go over to Wednesday. Now Wednesday, on March 20th, was an FOMC day. FOMC days are dangerous to trade. And yeah, you can make a lot of money quickly. You can also lose a month's worth of profits in a very short period of time. So I suggest, especially for those who are not expert traders or don't have a lot of experience trading, forget about trading on FOMC days. You can make a lot of money, yeah, but the trick in trading is to trade consistently, where more of your trades are profitable than not profitable. Okay, so FOMC days, let's forget about that. Again, on Thursday, March 21st, the Taylor calculated trading zone was support at 52.53 and resistance up at 53.02. So the Taylor calculated trading range was well below the prices that were printed during the day. So if you're going to use Taylor and you like Taylor to trade as I do, don't trade for that day. Don't trade for that day. The prices are not trading within the trading zone. Don't trade for that day. And again, on Friday, March 22nd, the Taylor trading zone was support at 53.07, resistance at 53.40. A 33-point range, but the prices didn't trade within that range. In fact, they stayed at Thursday's value area where Thursday's close was, but they didn't trade within the Taylor trading zone. So why trade? So there's 5 days here, 5 days. And on the 5th day, Friday, prices also didn't trade within the Taylor trading range. So why even trade? If you're not going to be sure, if you want Taylor to guide you, and I think Taylor is a great tool to use in trading, don't trade on Friday because prices didn't trade within the trading zone. Don't trade on Thursday. Prices didn't trade within the trading zone. Wednesday was an FOMC day, and yeah, prices stayed pretty much within the calculated resistance value area, rather, at Tuesday's close. But when the FOMC report was released, Don't trade within the FOMC day. Anyway, on Tuesday, look at this. You could have easily made 25 points for the day. 25 points for the day just by using Taylor. And on Monday, prices didn't trade anywhere near the trading zone. So why trade it? Why trade it? If you want to use a reliable tool, and Taylor has been reliable for 75 years, but not every day, because prices are going to do what prices are going to do, but they will always come back to the averages, and Taylor is the averages. And so Tuesday, prices traded nicely within the trading zone, and you could have picked up a nice profit. Forget about the rest of the week. So you can get the Taylor calculator here at my site, timelessdollar.com. And if you really want to know how to trade, there are only 6 trade setups. Gap, support and resistance, time and price, trend, momentum, and candlestick. There are only 6 trade setups. And 3 of those are pretty easy to spot. 3 of them, not so easy to spot. And if you take my course, you'll learn which is which. And so if you want to be a better trader, learn how to trade. Don't trade every day. Taylor is an excellent tool, and this is what the calculator looks like. If you purchase the calculator, you can use it for S&P E-minis as I do, or you can use it for virtually any market. The Taylor formulas work for almost every market. And so that's my video for today. Trade smart, don't trade every day, use lots of patience, and I'll see you in my next video. Thanks so much for watching. Marv Eisen for Timeless Dollar Trading Academy.